When it comes to the end of the year, nobody wants to have to pay the tax man a big lump sum of money, so any ways that we can reduce that tax bill are always a good thing. So the aim of this video will be to show you a couple of different ways that you can use in order to reduce your tax bill when it comes to the end of the year. Now the methods that I discussed in this video can be used no matter where you live, but I'm going to be giving some specific examples in the case of Ireland because that is where I live, but just do some research into how each of these different kind of methods work in your own country in order to get an example that caters to you. And before we get into it, if you could take 1 second out of your day to go ahead and drop a like on this video, it really does help out the channel. So the first method we'll be discussing is something called tax loss harvesting. Now what this means is essentially selling your losing positions when it comes to the end of the year. So let's go ahead and look at an example. Let's say you've invested throughout the year, you've mainly bought, but you've also sold some, so you have some profits, and we'll say it's to the tune of €2,000. Now in Ireland, you do have a personal capital gains tax exemption of €1,270 each year that you can utilize. And that essentially means any profits you earn up to €1,270 are completely tax-free. So back to our example, let's say we have €2,000 in profits, we minus our 1,270 exemption, and that leaves us with €730 that is now taxable. So of that €730, we would have to pay about €240 tax on that, but let's see if we can reduce that. So what tax loss harvesting is essentially having a look at your investment portfolio and finding positions that you are down in. So for example, let's say it comes to around the end of the year, we'll say November or December, and I have a position that, let's say in Amazon, that I thought would be doing well, but instead it's actually down 10%. So we'll say that the amount I invested in Amazon throughout the year was 1,000 and now it's currently down 10%, so I'm currently minus €100 in this position. So what I would do when it comes to the end of the year is sell that Amazon position, and that €100 loss can be offset against my profits. So that means instead of having €730 in profits that are taxable, I would now have €630 in profits that are taxable. And that means instead of paying €240 to the taxman, I'd now pay somewhere closer to €200. This is a great way to get rid of some of them positions that you don't have too much confidence in going forward, or even if you do have some confidence in them and you plan on holding that stock longer, you can still sell your position, take advantage of them tax benefits, and then just buy your positions back in the new year. Now the Irish Revenue do have something called a bed and breakfast rule, and in this they say that any shares that you sell, you would have to wait 30 days before you can buy them back for tax purposes, but they're not very strict on this and they won't exactly be checking it. Has it been 30 days since you bought it, so you could always just start to buy back into your position over the following weeks. But yeah, just let's sum up that tax loss harvesting rule again. So essentially it just means that you sell some of your positions that are currently in the negative in order to offset some of the money against your profits and just reduce that taxable amount. Okay, so the next thing to look at is especially if you're investing in the S&P 500. For example, I did a previous video on that and actually got quite a bit of interest. And in that video, we invested in the VUSA fund, which tracks the S&P 500, and it pays out dividends, and they would obviously fall under the dividend income, which is taxed at your marginal income tax rate. For more on that, you can check out the full video on tax. I'll put that little I notification up there. But essentially what I'm getting at here is instead of investing in this fund which pays you your dividends, you can also invest in an S&P 500 tracking fund that automatically reinvests your dividends, which means you don't have to pay tax on them dividends. And the ticker for this one would be VUAA, and it's available on Trading 212. So we have one more method here to wrap up the video that can be used to reduce your tax bill. And that is taking advantage of your personal tax exemption if you're a married couple. So if you are married, you are entitled to 2 times the 1,270 personal exemption, but it is still per the individual. It's not grouped as a whole. So unless you've set up your investment account under both yours and your partner's name, you'll not be able to take advantage of the full 1,270 exemption by 2. Instead, what you can do here is actually set up 2 trading accounts, one in your name and one in your partner's name. And then you can just go ahead and invest even in the exact same stocks or the same funds on both trading accounts, but now you'll be able to take advantage of the 2 1,270 tax exemptions. So what I'm saying here essentially is if you're married, instead of investing all into one investment account, if it's only under one of your names, maybe make 2 investment accounts so you can take advantage of that exemption. But as I said, if you do have a joint investment account, you should be able to claim for both the personal tax exemptions. Okay guys, so that's going to wrap up this video. If you did enjoy it and learn something new, make sure you do hit that like button and go ahead and subscribe to the channel if you're new as well. If any of you guys also have some tax saving tips, let me know in the comment section below. Let's get some good ideas flowing there and some knowledge sharing going on down there. And yeah, I'll catch you guys in another video.